So when a company makes a sale, when do they actually get to count it as money? Is it the second the product walks out the door, or is it when the cash is finally in the bank? The answer seems like it should be simple, but it tells this incredible story about a company's real financial health. Today, we're going to unravel the rules, the risks, and the real story behind accounting for what you're owed.
So here's how we're going to break this down. First, we're going to nail down what a sale actually is in the eyes of an accountant. Then, we'll get into the official rulebook they all have to follow. From there, we'll jump into the messy part. What happens when customers just don't pay? We'll look at how companies try to predict that, and finally, how you can piece all of this together to read the true financial story of a business.
All right, let's just dive right into the heart of it all with a question that every single business has to answer, from a tiny little shop to a massive global corporation.
And boom, right there, that's the central dilemma. If you count the revenue now, hey, your sales for the month look fantastic, but your bank account hasn't changed a bit. But if you wait for the cash, you might be totally understating how well you actually did. This tension between performance on paper and actual cash in hand is exactly what accounting principles were designed to manage.
Okay, so how does the world of accounting actually solve this puzzle? Well, to make sure every company is playing by the same rules and telling a consistent story, there's a common rulebook. It's called Generally Accepted Accounting Principles, or just GAAP for short, and it gives us the framework to answer our jacket question.
So GAAP gives us our first big answer, and it's called the revenue recognition principle. And the key word here, the only word that really matters, is earned. It says you recognize revenue not when you get the cash, but when you've actually earned it. So what does earned actually mean?
This is how that big idea of earned gets real, really fast. It becomes a checklist. First, you need some kind of agreement. Second, you have to have actually delivered the goods. Third, the price has to be set in stone. And fourth, and this one is huge, you have to be reasonably sure you're actually going to get paid. A sale has to tick every single one of these boxes before you can officially count it as revenue.
And here's the other side of the coin. For a true picture of your profit, you can't just count your sales. The matching principle says you also have to count all the costs that went into making that sale in the exact same period. I mean, that jacket wasn't free, right? Matching the revenue to the cost of the jacket is what shows you how profitable that one sale really was.
But let's go back to that fourth rule for a second. Reasonable assurance of collectability. What happens when that assurance was, well, wrong? What happens when the customer just never pays? This is where our nice, clean story hits a very common, very frustrating snag.
Yeah, it's just an inevitable part of doing business, and it has a simple name: bad debts. Now, accountants have two totally different ways of dealing with this problem.
Okay, on the one hand, you've got the direct write-off method. It's super simple. You only record the loss when you're absolutely sure the money's gone for good. The problem, that might be a year after the sale, which completely violates the matching principle. On the other hand, you have the allowance method. This is the one GAAP prefers. Instead of waiting, you estimate your bad debts right up front and record them in the same period as the sale. It gives you a much more accurate picture of how you're actually doing.
So how does this allowance method actually work? Well, it uses this clever little tool called a contra asset account. The easiest way to think of it is like a little savings account for expected losses. So instead of just listing all your receivables like you're going to collect 100%, you create this separate bucket, the allowance for doubtful accounts, and you put your predicted losses in there. Then you subtract that bucket from the total, and what's left is a much more realistic number for the cash you actually expect to see.
And this, to me, leads to the most fascinating part of this whole process, because it's both a science and an art. How in the world do companies predict the future? How do they sit there today and estimate which of today's sales are going to go bad down the road?
Well, they have a few tricks up their sleeve. They could use a simple, broad percentage of their total credit sales, or maybe a percentage of all the money they're owed. But the most sophisticated approach, the most accurate one, is called the aging of receivables method. It looks at every single unpaid bill and groups them by how old they are.
And check this out. This is what that method looks like in the real world. The company breaks down every dollar they're owed. For the recent stuff, the bill's less than 30 days old, they figure only about 6% will go bad. But look at that last row. Once a bill is over 90 days late, the chance of it not getting paid skyrockets to 30%. So by adding all these different buckets up, they get a way more precise estimate of their total expected losses.
Okay, so we've been through the rules, the problems, the estimations. Now let's talk about the payoff. How do we use all this to look inside a company and read its true financial story?
One of the most powerful tools for this is something called the accounts receivable turnover ratio. It's a single number that basically gives a company a report card on how efficient it is at collecting the money it's owed. And simply put, a higher number is always better. It means cash is coming in the door that much faster.
So for our example company, BWW, their turnover ratio was 5.14. Okay, so what on earth does that number actually mean in the real world?
It means that, on average, it takes this company 71 days to turn a sale on credit into actual cash. Think about that. That's more than 2 months. This is a really critical sign of their cash flow health. Now, an investor wouldn't just look at this number by itself. They'd compare it to competitors to see if 71 days is considered fast or slow for the specific industry.
But, and this is a huge but, here's the final twist in the story. Remember how we said that allowance for bad debt is just an estimate? Well, that creates a gray area. A company could just decide to be a little more optimistic about its collections, lower its bad debt expense for the quarter, and poof, instantly make its profits look better, all while technically staying within the rules. This practice has a name: earnings management.
This flexibility places this immense ethical responsibility right on the shoulders of a company's accountants. As this quote from the International Federation of Accountants makes so clear, they are the ones on the front lines defending the quality and the truthfulness of the financial story that a company tells the world.
And that leaves us with the billion-dollar question. For anyone looking at a company's financials, you have to ask yourself, where's the line? When does using the flexibility in the rules stop being smart management and start becoming unethical manipulation? Understanding that difference, well, that's the true art of reading the story behind the numbers.